Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So it's a little bit light on the data side, which is nice. We can catch up on some stuff. We can catch up on some things that have been happening. But the first piece we're going to look at is just the global leading indicators. And it's interesting because some of the leading indicators are starting to bounce a bit. And then on other sides, when you're looking at trade and you're looking at stuff, like volume of stuff, it's actually slowing. So sometimes it's just a matter of timing in terms of where some of these pieces are. But as we've been saying the whole time, it's like, and people may come at us and say, oh, you're too bearish. It's like, well, we're just telling you what the data says, but our whole thing has been, this isn't like, we're not in a world right now or an economy that's just going to collapse. It's going to get to a point that's going to be contraction. We believe it's going to contract, but didn't just kind of go sideways. And that's that stagnation, that stagflation that we keep talking about. And that's kind of what continues to play out. So we may come out doom and gloom, but it's something where it's like, that's really the overarching thesis of kind of where we sit. Now, U.S. GDP, and then we're going to follow it up with U.S. GDP slowing, and there's additional pressure into Q2. And then in the section after that, we're going to talk about, well, what is the pressure in Q2 so far? Where is it going to go from here? And then we want to talk about European service PMI, because the service side continues to hang in there while manufacturing weakens, construction weakens, and we really want to look at, okay, well, is that going to be enough for the ECB, and how is the consumer going to continue to trend over the rest of the year? And then in the final segment, we want to look at, has Chinese housing bottomed? Are we starting to see some of this turnaround? Is some of this front loaded and it's going to weaken again? And those are some key pieces because it's a bit mixed. But with that being said, it is starting to put in a bottom. The question is, does it bounce? Or does it just stay at this depressed level? And for those that have been following us, we believe it stays at that depressed level, but we want to show you why we think that and why some of these early bounces could be a bit misleading, or things that are going to wane over the next few months. So with that being said, we want to turn to gold purchases, because it's always interesting to see what are central banks doing, how are they reacting, and you'll be surprised to know that global central bank gold purchases have soared of late at a rate not seen since the late 1960s. And when you think about gold purchases, it's all about containing inflation. So when you look at it, we did the whole show on the US dollar. The dollar's actually increased on a reserve currency basis. It's actually increased on a transaction basis. But there's still a desire to have something physical, some sort of commodity you can point to that has a very finite amount in circulation that you can show that what your currency is backed against. This is something that is going to backstop us. So I think this is a bit more telling when you think about what the view is on inflation and what the view is on what inflation is going to look like. If countries, really believe, oh, inflation's transitory, this will come down. It's like, would you really be buying gold in this level? Or is it some sort of additional push to diversify and not rely as much on the dollar? And you can play this from both sides. I think it's a mixture of both. You've seen the concerns about the dollar, and we're going to show more of that in segment 2 in terms of, credit default swaps, what is going to happen during the debate for the increase in the debt ceiling. And these are some pieces where people are like, look, we've relied on the dollar. We need to rely on other things as well. We do think, and we've been talking about in general, that there's going to be a new Bretton Woods, and our view is that it's going to be really based on how many commodities or physical assets do you have, and gold is an easy one to point to, and I think that's going to be important, and I think a lot of that is coming through. But also China, Russia have been big buyers, and there's ways that they're trying to diversify, but as we've been saying, you're not transacting in gold. you're transacting in something else, and again, the dollar still remains supreme to that. But when you look at stuff moving, so when we look at in the U.S. truck tonnage index, you can see that nice collapse, which again aligns with everything we've been talking about from freight waves. As you've seen stuff that I've retweeted and talked about from Craig and quoted his stuff. I've dropped the freight waves things into both the EIA shows, into the econ shows to show you that, like, look, things are slowing and it's below 2019. There's a lot of pressure, which is fine. But then the question is, okay, well, let's look at freight indicators outside China. And when you look at port traffic, so North Europe, world ex China, when you look at these pieces in terms of just global activity, you can see that there is a lot of downside. There's a lot of this contraction that has continued to come through. And when you look at 2019, and again, turning back to the U.S., and things that we've talked about, and again, supporting the freight wave stuff, is we've said, look, things are worse than 2019. And this data is really showing you exactly what we've been talking about, where we had this massive surge, 21, 22, but then 22 started to really soften. And you really started to see these impacts, and now you're seeing that follow through at a greater and greater level. Like in a lot of these instances, it's well below where we were in 2020. And that's where, again, when we look at the different pieces, when we look at these pressure points, this is a problem when we consider what the freight volumes look like. So then when you start looking at other kind of key indicators, so you look at Taiwan. Taiwan has inherently always been a very good bellwether for global exports, especially when you start looking at the tech side. So weak Taiwanese exports are consistent with the negative global profits, the negative global flows. When you look at where it is and heading into August 2023, again, looking at some of those leading indicators, but we're negative, and that's what we've been talking about. We're in contraction. It's not contraction like we saw in '08. It's not contraction like we saw in '01, but it's something that is leading in that direction, and we think that that's going to continue, which again puts us back to why we're more concerned about the emerging market world and why we think that's going to have an outsized impact. U.S. container imports in 20-foot equivalent units. Again, just trying to look at that TEU side. And here you can see what 2023 looks like. Well below 21, well below 22. And as we've been highlighting, below 2019. And as the U.S. being the largest economy, the largest buyer of stuff in the world, this is one of the leading indicator problems. But when you look at some of the leading indicators on the ground and manufacturing PMI, it's going sideways. So one of the things that we've talked about is that things come down. You saw this precipitous drop in 22, but again, then it flatlines, and then some people have to order. You still have a business to run. You still have to provide and have stuff on the shelf. So then you kind of go sideways and you bounce around a bit. And then we think that there's will be a little bit of a continuation. But if you look at going into, obviously not into 2009, but if you look going into 2011, 2012, 2013, you just kind of bounced around. And that is what a lot of this is showing. And if you break it down by country with those leading indicators by country, you can see that contraction. We're still showing contraction with that 100 being things flat. And the general piece is you're 2-3% below normal. China's slightly below. And again, that's what we see right now is that we're having a bit of a balancing act. Now, we do think there is another downswing, but it doesn't mean that it has to happen all at once. It just means that when you look forward, it's like, look, I see the pressure, it's building, it's there, but if you didn't order, and if you look at Q1, inventories were drawn down, people were trying to optimize where things are, so then you have a bit of a restocking. So that is going to pull some more product through, that's going to have some more orders. And again, it's not going to be to the same level because the economy isn't booming, people aren't buying stuff off the shelves. It's a mix and it's a balance, just like everything else with the economy. It's a dance, it's a living, breathing creature. And that's why it's, you don't just, it doesn't just die all at once. It's that balancing piece, and that's where we continue to see some of these movements. And the economic surprise index has bounced. When you look at where some of the things are on the composite PMI, a lot of this bounce, but again, it's driven by services, which is driven by consumers. So if there's anything I've learned over my career, is that the consumer is fickle. So as the consumer is fickle, it's hard to gauge when where the pressure point is. Everyone has their pressure point. For me, it's my savings account. If my savings account drops below a certain point, there's a panic and then there's a change in consumption. And that's just a trigger. Luckily, based on the fact that I'm a crazy person, and I'll call it frugal. I won't call myself cheap. I'll say it's frugal. I'm good at managing that. And some people aren't. Some people will spend and spend and spend until they hit that pain point. And they're like, oh my God, I can't believe I got to this point. I have to pivot. But there's 9 some odd billion people in the world. Everyone has a different point, especially in the developed world. So that's why that's a long way of saying it's hard to really nail down that pivot point. We can look at it and try to suss out. It's like, look, based on this, this, and this, it normally happens here. Based on this, this, and this, it normally takes 3 months for that to come down to the consumer. But we do remain concerned on the consumption side. And that's why even on the economic surprise index, even though it's had a nice bounce, you can see it's actually starting to roll over a bit. It's starting to curl and come down. And again, not to say it's going to collapse, but that's going to be an important one to watch. And a lot of that is going to be on the back of what we think is going to be a lot of excitement around China. China's starting to disappoint a bit, and some of that coming back to normal. But in the meantime, when you look at global stock bond ratios, and we'll talk more about this in the next segment, bonds are telling us a story that stocks either don't care, aren't listening, see something different. And then when you look at just unemployment rates, things are still fairly tight, which is why when you look at G7 unemployment rates, when you look at that, is there any reason not to continue to tighten, not to continue to raise rates? And then the global return on equity is still elevated, but as we've been saying, and as that shows, more pressure to the downside. Now, we just wanted to wrap up with one of these key pieces here, because I gave a presentation about the new energy paradigm, how it's a basket approach. You can't go all in fossil fuels, you can't go all in green. It has to be a matter of what is the topography, the geography, the solar exposures, the wind flows. And here we have to get serious about where is this product, where are the products built, because obviously we know what's happening in Russia, we know everything that's been happening there. So what comes next? Where are we going to pivot to this and say, well, in order to ensure that we don't put ourselves in the same position, we need to diversify our supply chain before it's too late. And when you look at China, it's a perfect example of where we get a significant amount of everything from polysilicon, PV cells, modules, everything we rely on China. So we have to really look at where are we going to get some of these things and diversify before it becomes too late and things escalate with China as we think they will. And again, the escalation in geopolitical terms is measured in decades. It is not measured in days until it's too late. Once you're at maximum risk, then it's just a misunderstanding, a misfire, and all of a sudden things devolve quickly, as we've seen throughout all major conflicts major revolutions, civil wars. And that's something that we're going to have to continue to watch for and talk about as we go through, but just gives you an idea that we have to get serious about it now. And I think people are finally starting to get the hint, following the issues with COVID, following all the supply chain problems, but this is just something to pay attention to as well. So that's what we have here on the global front. In the next segment, we're going to go deeper into the U.S. data, U.S. GDP, what happened last quarter, what's going to happen this quarter and beyond, and how do we see things shifting.